Yo, what's happening here? I see a big green candle. We have 10 minutes until Powell speaking. That's quite interesting. It's quite interesting. We spoke about this earlier on Run Show, and if we have a look at this, it's sort of, I said 50 basis point. That was obviously an unlikely sort of thing. We ended up getting 75. We now do have the speech to see what's going to happen, but right now, sort of following this scenario over here. Now it's interesting. It's interesting to see how we're starting to shoot up. Now, remember, guys, ultimately it's a few days until midterm elections. Like, will they dump the market now? And I think that's been the biggest question throughout now. We know how this has affected the market many times over the last few weeks. And we've always had this market sort of moving to it. And it's like the question is, the stock market's been running for days and days and days now. Are they going to leave it to continue to run? Because we are at important levels, not only for Bitcoin sitting near the $21,000 zone, a breakthrough the Bitcoin level over here. The next one is towards 23,000. This is a very big gap. So we know we're at a critical stage of Bitcoin. We know we're at a critical stage with the Dixie. We're sitting at a level where finally we can possibly be dropping, a trend that we've been forming throughout the whole year. And if you have a look over here, you could see this trend, how we did eventually break it. And this is sort of, something I dropped a few days ago, that if it's a bearish pattern, this is where we should get, a rejection from the Dixie. And it looks so far that we are getting a strong amount. Now, we're not going to get excited too soon. We are going to watch the speech. Let's see what happens. Let's see how the markets react to that. But guys, if all goes well here, and we can have the Dixie collapse and we can have the stock markets, let's look at the futures for a sec, which is looking pretty strong. And I did draw out the two scenarios as well this morning. And, if we break this level, we could be looking at another 5 to 7% up in this first leg. Now, there will be pullbacks at different times. It was all about, is this the temporary high? Is it the high until we do have a decent pullback? If we do, that's sort of the area that I'm looking at. But there is a possibility that we go up to this level over here first. And that is quite a big gap for the stock market. If it does go to those levels, which is very interesting, it leads us to a very interesting part of the end of the year. We will then be sitting in the region of 8% from all-time highs. Like, what do we think, guys? What do we think? Please comment below. In the show, I'm going to go through all the tokens with you guys. Let's watch it live. I was cheeky. I'm not going to lie to you. I was very cheeky. I did take two little longs earlier today. And you can actually see with them, I managed to sort of get them right at the bottom, which is pretty good. But you could see it's very small, wasteful cash that I'm doing it on, because it's not always the time to trade. But we also know if this market erupts in this level that we're at now, it could be quite crazy. So let's watch it live. Let's go through all the different charts. We can go through tokens as well. If all of a sudden the market erupts and Bitcoin breaks 21K, there is altcoins that have not run just yet. And I kind of feel that not are we out of this bear market, but I do think the rally of 25, 27, 28 to finish off the year, then possibly dump through the early of next year, it could be a possibility. And if that happens, we have a lot of alts lagging and shit could get real pretty quickly. Let me know what you think, guys. Pop in the comments. In the meanwhile, Paolo, please play my song. Let's get into the mood and let's hit it. Let's smash it.
Click, click. Have you heard the news? What? With his finger on the pulse, it's like Sheldon knew. Click, click. When the sniper shoots, we got Sheldon on the charts, so we never lose. Enter the sniper, sharpshooter advisor. Enter the sniper, he marks the charts right. Enter the sniper, he's calling the cycles. So enter the sniper, click, click, click. Time to be dedicated, sniper mode is activated. Explosions in the market are in target, and Sheldon demonstrates. Mirror, mirror on the wall, Master Sheldon tell us all. We got Sheldon on the chart, so we never lose. Enter the sniper, sharpshooter advisor. Enter the sniper, he marks the charts right. Enter the sniper, he's calling the cycles. Enter the sniper, click, click. Enter the sniper.
Yo, Banter fam, what's happening? I hope you have your tea. I have a cup of tea tonight. It's a little bit coldish to the side, a lot of wind. So I'm having a cup of tea. I hope you got your popcorn ready. It's another eventful evening. If you are new, smash the subscribe button. If you're part of the family, smash that like button. Before I do get into this, what are we? We are 5 minutes away from watching. We can see what happens. If you are brand new, guys, remember that we are running a trading competition at the moment of up to $100,000 in rewards. In order to be a part of it, you can sign up with our ByBit or BitGet link, which is below. If you are looking for exchange, we do trades on the channel at different times if you want to be a part of that. Not only does it support the channel, but what it also does is it gets you into our private Discord where you're able to get many different calls, VIP section. All you have to be is using one of our referral links. If you want to do a trading competition, if you're badass and you're really good, come have some fun with us. It's been a good time so far. Shout out. All right, guys, let's jump in. Let's have a look. What's happening right now? I can't believe it. The market was looking extremely bearish earlier. It was looking pretty sad. I'm not going to lie. It wasn't looking the best. But right now, we do have this pattern playing out. Not getting hopes up just yet. Not getting hopes up just yet because, like I said, stock market's still got to break the previous high it made a few days before. Dixie does have to really get rejected in these areas. But we're going to pay attention to this because if all goes pretty good, we should have a great retest within the show, which could be a nice little add-on zone. But ultimately, we want to see, can we finally get a spark to get through the 21K? We've been fighting here now for a few days. And we know the gap's pretty big to 23,000. And then there's a big gap to 25,000, big gap to 28,000, and then 32,000. It's quite crazy to see. Like, we have been pretty bearish, and I know a lot of people are like, it won't do it. Like, we never know. Maybe Bitcoin does wake up and do some crazy things. How are we feeling, guys? Pop in the comments. Where we from? What's happening? We have a few minutes. Then we'll jump on. Tell us fundamentals. So this is one thing, guys. I nearly didn't do the show because I was like, I don't really understand these full meetings. I just know 70 is okay. 50 base support is bullish, and I know 100 is really bad. So I'm a chartist. Who's this guy? Are you chilling? Wait. Quick question, right? Did you get first class, bro?
Business class. The first class is full.
Dude, what do we think? 75 basis. We're breaking the trend. Yeah, we spoke about it earlier. Look at it. You can see
It all
over here.
depends on what.
Okay.
It all depends on what Powell does.
Okay, so now we've gotten 75. What do you want him to say to be bullish? That things are going to taper down, they're going to slow down. Like, what is the scenario? Because we're about 2 minutes out, and we'll jump on it.
So he already inserted one line into the minutes, and in that one line, they're basically saying that they accept the that there may be a lag in their policy, which shows that they may slow down. So already this is a very good effort. But listen to what happens.
We're losing you slightly, brother. We are losing him slightly, but I will bring him back because once they've done, I hope he's going to sit here and watch so they can see what they said. So he can jump on after and give a little bit of his knowledge. You know, ran the fundamentals. He's a king at it. He ran. He doesn't stop. I agree. But he's here, guys. He's here. Okay, how far are we? I think let's jump on. So, like I said, guys, let's see how this goes. The movement, there might be some good load up, but I do feel we got to pay attention to 21K. I think there's still a lot that's cheap that hasn't run just yet and hasn't done anything. So if we get this breakout, let's actually keep a quick eye. So I'll be jumping through the charts as well for you guys as he look at dominance. Look at dominance. Interesting. Very interesting. So if Bitcoin, if this had to tank like this and we lose this low, because I remember higher time frame, I remember that we actually got to really important levels with the dominance. Guys, if we lose this low, you know, and we got Bitcoin breaking 21K, crazy altcoin move. Definitely crazy altcoin move. You know, we've seen it over the last few days, and that was this little leg over here. If we drop these two support areas over here, this one and this one, the gap's huge. And then after that, it's the all-time low of 35. Like, we're not far. We're really not far. So, yeah, ran the degen. He's a proper degen. He really is. He's on his flight and he's here. 10-year yield, critical level, Dixie. Okay, cool. Let's go have a look and see what's happening here. Just confirm, guys. Confirm you can hear. So when that other music was playing, just confirm. Just confirm. I just want to make sure you guys can all hear. So let's see. Can you, Alan, Craig? Okay, you can hear. Great. Cool. Let's do it, guys. Watch, enjoy, and I'll be bringing up the charts. Let's see what happens. No sound. Some guys can hear, some can't. Okay, I'm getting started, guys. Okay. Let me Cool, guys. I'm going to sort it out quickly. Craig, can you pop a chart up there? Let me jump on and off. It will come on. We'll get it back on now, guys. Sometimes the StreamYard does not get it. Craig, can you get up a chart? Cool. Welcome, Craig. Craig. Okay. I'll see you guys now.
Okay, guys. Yeah, Sheldon, just check your settings there when you share that you might have the sound. But at least if you show Powell for now, we can see the subtitles. I haven't even got it. So all I can show right now is so look, and you should be able to see the Dow, which I've got set on 5-minute charts at the moment. So, and we can see the reaction to what he's saying over here. I am speaking blind because I can't actually even see that you can see what I'm seeing. Just zooming in here on the 5 minutes and just having a look as the reaction is, you'll notice that it will bounce up and down. For sound, okay, let me get that. Sorry, someone's just sent something else that we can get. Let me just push this through, sorry. And what I'm going to do is I'm going to try and get the sound up on my side.
Yo. Yo.
Okay, remove my stream.
Can you hear
What have
me?
you got there? Yep.
Okay, amazing. What's up, guys? I had to restart quick.
So what have you got? We've got nothing happening on the markets.
We're getting it sorted now. Can you hear?
It's not up. No.
No sound.
Rather just watch the charts there, huh?
Yes, it's so annoying, bro. I can hear it.
You can hear it.
Yeah.
But then check your sound settings on StreamYard.
Yeah, it's not right. That's all right. There's nothing different here to my normal. Let's have a look. Yeah.
Market's going up a little bit now.
Still can't hear.
No.
Okay.
Increase.
There was something there for a second, Sheldon. It seems to be trying to come through. I don't know what you're doing.
Yeah, FX act like that. Let's see what's happening on the charts. Let's see what's gonna happen here. Let's see, guys. We know how the market likes to react. We usually pump up into the actual meeting. Then we do have the. So ultimately, guys, what we're looking at here is 20K support. We don't really want to go below 20K, and 21K is a breakout. So we do like to. We've seen this before, where we do pump into the actual events, and now we're obviously going to see how what questions are asked and see how the market actually reacts here. But for me, worry levels 20, breakout levels 21. That's ultimately the thing that I'm looking at. So I'm short term long. I am short term long. My sound pretty bad. I do apologize, guys. I don't know. Sometimes we will have issues. It happens. It happens. It happens. My sound is bad. Apologies. Come on, Bitcoin.
Sheldon, check the link that I've put in our group. Maybe that one works.
That's not my computer, bro. I need someone else's computer or something to jump on here. I don't know. to stream it. I don't know why it's not. I'd have to reboot the whole thing again, and that can end up taking 5-10 minutes. So guys, what I am going to do here, yeah, the sounds a bit terrible tonight, so I do apologize, guys, but ultimately I do want to be here through this and just basically give you the key levels on what we're looking at and how we want to see this basically play out.
And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report,
I can hear. Can you guys hear?
Ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy. Well,
sorry, guys.
Economic activity and inflation. So say as we come closer to that level, move more into restrictive territory, the question of speed becomes less.
So now we have a look. Craig, put it back up there, please. Yo, bud.
When you share, blow the screen, click the button that says share computer audio. You'll see it on the bottom left. And I think you'll be good.
Okay, just play it there for now. We'll double check after. Just play it there for now. We got it. Let's not ruin a winning recipe. Guys, how are we feeling? What do we think? Do we think we're gonna, the sound's coming. Do we think we're gonna pump or dump from here? Like, what are we thinking?
Driving ahead, and everybody else, dealing with their own stress as a result.
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this. And as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. There are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level for sure, substantially above for some time. You'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley with New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change.
While we're waiting for that, guys, I just want to have a look. So Bitcoin, small sort of red candle. We're still waiting there for now. I think what's interesting is to obviously see, I heard the Dixie having a small push up. I think ultimately if we can break the low, then we'll know. And stock market, let's have a look. I don't know. It doesn't look too bad as we speak at the moment. It doesn't look too bad. Let's obviously see if there's anything really bearish, guys. End of the day, the market's been bullish for the last 2 weeks. What's going to stop it? Is there anything? And I want you guys, I'm not the crazy fundamentalist here. I want you guys to tell me, like, this was bearish, this was thing. If it's okay and it was like plain news, I think the market's rip. I think we've got to focus on longs. I really do. Okay, wait, something must be happening. Go back there.
Inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them because it's appropriate to do so. Let me say this, it's it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive. And we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Housing, the housing part of it. Yeah. So, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages. So I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity there. With the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down, that compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but, we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy. And we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully, even though it may be difficult to get it back. Getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas. And they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make was covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending? I
don't. So as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General, with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill.
Lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Can you hear?
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context.
Guys, I went long, like
our
cheeky long.
tightening program,
I don't know.
if I may, and hit to talk about the statement language along the way.
Long.
So I think you can think about our tightening program as really addressing 3 questions. The first of which was and has been how fast to go.
Let's go.
Second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy,
I don't know, it
it's
seems
been
bad,
very
but it doesn't
important that
seem
we
like
move expeditiously, and we have clearly done so.
any worse of what we've been
We've
through this
moved
year.
3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement.
So many degens.
Because that really does become the important question, we think now, is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects.
Long or short, guys, long or short.
So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that
sorry, guys.
Much less important than inflation. They go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lag?
Of course, good at picking up the at the margin, the new leases. And, they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did. And now they're coming down faster. So the implication is that there are still, as
I don't know,
as non-new leases roll
market
over,
holds, it's still good.
And expire, right? There's still in the pipeline. There's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening.
This speech is always so long.
So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to
see the markets
and
not doing anything.
That's just we take all that as a given, but we know what our objective is, and we know what our tools.
Probably going to happen after the stream, or
that's how we think about it.
I don't know if it holds this wedge. For me, it's like.
Hi, Chair Powell, Nancy Marshall.
It's good. I'd obviously give it a little bit of time, but
I'm
for me, this is a bull flag.
Has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not. and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Is that it? Let's turn it off. All right. Okay. It didn't sound like incredibly great. It did sound pretty bad. But I am pretty impressed that price hasn't dumped. So usually, especially this far in, since it started, we usually have quite a big reaction in the markets. Right now, as it stands, if Bitcoin still holds that wedge, we are sitting, guys, as I said previously, we are sitting between 20K as support and 21K as breakout. Maybe this settles. For me, I'd be happy that price will probably go down now. It probably would, or it will just sit here for a little while. But if we can hold 20 and ultimately we can get the RSIs to remain bottom at the bottom out, if you want to call it, on the 4-hour and 8-hour, for me, it's good. I think the market continues. As long as we don't, if we break this wedge to the downside, there can be low 19Ks again. I don't really think we should go back down there. I feel that this is one of the pumps that, if we had any chance of bullishness this year, this is the pump. This is the pump to do it. This is the time to do it. I don't think that came out as great when you take it, but I don't think it came out too negative either. And if we could basically have a balanced market where the people don't take it too much in either way, I think the market continues bullish. I really do. Because the market is bullish at the moment and it is breaking major structure. And as long as we don't have anything to slow that down, I still think for midterm elections, they're going to try push it. So ultimately, what I'm looking for here is I did have cheeky little longs, but you do have to protect, and I will obviously smaller them a lot if we don't start making progress soon. But ultimately, 20K is the level for me to possibly load up on some. Now, we obviously have a few tokens which I'm definitely taking advantage of. BNB is one of them. But what is interesting is these actual pumps from Litecoin. It's quite LTC. Quite interesting. And we're basically looking at moving where the money is right now. We're getting these crazy little altcoin pumps that are coming out of nowhere. And if we look at Litecoin, this is interesting. It's at a very interesting level, especially from a very high time frame sort of view. So remember, guys, we're still ultimately waiting for 21K as the breakout. That is the level. Now, if that does break out, the gap's pretty big. And you can basically see how the gap is here on the altcoins too. You could see this big gap over here, this area where we have this really big space in between from where we are now to there. So for me, keep an eye, because I don't think the markets, there can be a pullback to 20, but I don't think the markets would have reacted a little bit stronger now. We'll see. I may be wrong. We'll see. But for me, I think that we settle down in this area. I don't think we do too much more damage. And ultimately, I'm waiting for the 21 or this 1-hour wedge that I showed you guys earlier. This one over here. If we can get a close out there, we do know it's a legit one now because we've had 2 weeks that went out of it, but we have not closed outside of there. So any close out there, I won't be going too crazy to yet. I'll probably give it a few hours, but ultimately I think Litecoin is a big one. I think XRP is a big one. I think Gala Games is a big one. I think Solana and Cardano still have another leg in them. I think Near Protocol is cheap. So keep aware of that, because it does look that whenever we will get bullishness again, that looks like dominance will collapse and will continue this momentum to the downside. So DXY climbing, guys, we've got to keep some eyes. So I will definitely be doing a show tomorrow to see where we're at. But if we hold 20 and my 4 hour and 8 hours has a reset tomorrow, I'm bullish. I'm coming in bullish. I'm coming in hot. I'm going to be giving lots of coins, lots of different trades, and we're going to continue this damn thing. I do believe for the midterm election that we should have some sort of pump. I think December, January, we get destroyed. So we're getting out on this next pump. I still think there's a decent pump though. And when that pump's done, then I think it's time for us to, I think we're going into recession. I think we are going into yeah, I'm mad after buying what it's just said. It is. This is leverage, waste money, guys. Waste money, waste money, waste money. If markets turn bullish, I'm smart, right? Let's see. Let's see what happens. Okay, guys, I'm gonna go shoot. I was chilling with the family. I wasn't gonna do the stream, but I am definitely here. I love you lots. Hit that subscribe button. Make sure you're part of the family, and I'll see you all tomorrow. I do apologize for the lot of amateur mistakes. It happens. It happens. But I've been here many times. Much love, Ant fam. Much love.